Hello, everyone. Good morning. Good morning. Hello there. Welcome to our Founders Playground. This is the day 2. Yesterday, we already have a session, Entrepreneurs Mindset, Founders Played It, and also the Corporate Startup. I know it's Saturday, and I know you guys maybe now is, planning to go out or something, but here we are, and now we are doing we are on Zoom, but also we also stream on YouTube, so that our friends who cannot make it today with us will can see the recording of this session. So today we are going to have the 13 minutes play talk, and we'll discuss about the funding dilemma, because next week we have 50 startups who will join the speed hustling. So this Founders Playground is happening from 3 December until 9 December. Well, we all know that now, as the pandemic swept over the world in the recent years, building startup has become a remaining challenge for founders. So that's why we, Tambo, Equipa, and also Amiga, collaborate in initiating this Founders Playground. Why Founders Playground? Because we want to make a playground for our founders and entrepreneurs with a fun and entertaining approach. So that's why, if you notice, our approach is very light, very fun, because we want to make as open as possible. So like yesterday, if you guys watching this and you would like to collaborate with us, and then feel free to drop us a message in our Instagram, and also follow our Instagram and or also our LinkedIn. You can ask anything, or maybe you ask us to collaborate. So this Founders Playground, we have a lot of sessions. We have 13 minutes play talk, and speed hustling, and also Founders Played It, and also next week we have speed hustling, and with participating investor, Aksara Ventures, and of course Bali Investment Club, and Gaio Ventures, Genesia Ventures, Indogen Capital, Spiral Ventures, and also Venture Capital. And also we would like to say thank you for Zendit and AWS Activate as our speed hustling sponsors. And thank you our community partner, Agile Circles, Cakrook Indonesia, Founders Life Indonesia, Block 71, Cubic, Palembang Digital, Sumsel Startup Founders, and Fujitsu James Indonesia alumni. And also thank you for our startup and corporate partner, Telkom Indonesia, Right Partners, FUM, Unanco, Fitloop, EduCourse, and also, of course, BukaPO. And this event is proudly brought by Tambo, Equipa, and Amiga. Let's have fun. And now, we would like to invite our speaker for today, and of course, okay, Tom is already here. Can you spotlight the Tom? Hi, Tom. How are you?
Good morning. Doing very well, and yourself?
Good morning. Yeah, I'm good. How was Bali?
Yeah, Bali is great. We got no rain for 24 hours, so that's a nice change. And then otherwise, very, very busy. The last week has been crazy, but very excited to be here today and to share the session with you and with Olaf, of course.
Okay, and also the second one we have Olaf. Hi, Olaf. I think you're still on mute.
How are you? Hi, Tom.
Morning, morning.
Morning.
Hi, Olaf. How are you?
Good, good. Very good. How are you?
I'm good. So gentlemen, so we already have you two on this screen today. So the concept of 13 minutes play talk is that we invite two speakers from two different perspective or different angle, And we challenge the speaker to share their 13 minutes, to share about the, the point of view, to share knowledge regarding the subject that we pick. In this case, we pick the funding dilemma. So we want you to share first, maybe Tom, and what is the funding dilemma in the investor's point of view. You have 13 minutes to share. And then after that, Olaf, you will share in 13 minutes what is the funding dilemma in startup points of view. Because we also know that BukaPO is recently get funding, right, from Bali Investment Club, and you, Tom, a lot of speech participant in the group, in the chat group, who are also waiting for your session, because next week they will meet you and pitch in front of you. So I hope this can give them a better insight about this the next for the next week pitch. Okay, now I think we can start with Tom first. You go first.
Sure. 13 minutes, hey? That's going to be quite a... We may run out of time on this one, because Olaf and I have known each other for almost a year now. We started our relationship just almost a year now, and it's been an amazing journey. And I think one of the things that people always neglect when it comes to like business partnerships and funding and things like that, it's the actual relationship. And it's not just reaching out to somebody and saying, hey, listen, I need money for my startup, but it's actually building a relationship with that person. So on a human level, but then also from a business level. And when we first spoke, with Olaf in the beginning of the year, this is pretty much where we kick things off. We met, I think, what was it, at Milu by Nook, I think?
Yeah, I think
somewhere in Canggu. And Olaf had just reached out to us, and then we met over for breakfast and had a chat about BukaPO. And it was like, let's say, the concept of BukaPO was really, really special, at least in my view, because of the nature of who it's serving, and it's really empowering Indonesia's informal sector. But as much as I can get personally excited about a project or adventure, I represent, let's say, the views of our company. And the views of our company is obviously the other board members, the investment committee, and the investors' capital that we represent. And so this is where I think the dilemma starts, to play out, because it's not about whether, I think the company is great or I see potential in the company. It's whether we can actually build a strong investment case for the company. So of course, any sort of funding that you will ever get as a startup, you're essentially borrowing money either through a loan or you're issuing equity for cash. And either way, the investor, the person putting that money, has some expectations. They say, listen, if I'm going to give you $100,000, what do I get out of it? How do you give me more than $100,000? And then how do you make sure that that money doesn't get lost? Because we all know that, starting a company is a huge challenge. And sometimes it takes a couple of tries to actually get the recipe right. And it could end up being with a completely different concept. So there's always a big risk attached to, to starting a company and to funding a company. And so as an investment vehicle, we obviously have to make sure that the deals that we offer to our investors have really strong potential. And so that we obviously manage our reputation like that. We manage our investors' capital. And then we make sure that we also back the right companies, in the sense that in our experience, not all companies are ready for funding when they think they need funding. A lot of the time is, bootstrapping or keeping things cheap is the best way to test your company and to innovate in the early stages. And money becomes one of the last things you need when your company starts to grow. So with Olaf, for example, we had the chat, and I absolutely loved the concept. and I immediately wanted to back him. But from an investor's point of view, we couldn't say yes right away. Olaf had been operating, I think, for 3 or 4 months. So just got into the Bali market. The initial traction was good. All the initial signals were good, but it was just too fresh. So keeping the investor's hat on, I advised Olaf to basically keep in touch. We spoke about some, let's say, key metrics of the business that were important for him to monitor, and which would be metrics that we would look at, which is essentially monthly recurring revenues, drop-off rates, so customer retention, customer lifetime values. So any of the key numbers you'll see in a SaaS. And I said, Olaf, okay, cool. Keep an eye on those. We can touch base over the next couple of months. And once you've got a couple months behind you, let's chat again and see where you're at. Because most startups also fail within the first 6 months. So for us, it was also a bit of a test in the sense like, okay, if BukaPO is still operating by June, especially in this context, it means that it's got the base recipe right. And for us, that was an amazing signal. And that's the signal we were looking for. And I think it was in June. Yeah, we chat with Olaf again. He showed me, his numbers, what they were able to achieve in the last 6 months. And then I had the confirmation that BukaPO was a company that was ready to be backed. And so I presented the case to my partners. And I think within less than a week, Olaf, or something like that, we got the deal going.
Yeah.
Then it happened really quickly, because what's amazing, and when you have that relationship and you're building that relationship over a few months, is that the due diligence happens across that relationship building. So I already knew Olaf. I knew I could trust him. I'd seen the company progress. So we didn't have to do all of this crazy due diligence. When we had our second session, we knew straight away who we were dealing with. So we just focused on chatting about the next steps and saying like, okay, cool. We want to open a ticket for 100K right now. What's the best way to serve BukaPO with that money? And how can we assist Olaf from a mentoring and from a, let's say, a strategy point of view to get the ball rolling? So we aligned on that. The money came relatively quickly, a bit slow at the beginning because everyone's always a little bit shy. And then as it happens, in the last week, we were getting calls from investors left, right, and center wanting to fund BukaPO, but we'd already closed the ticket. So that was an amazing win for all of us. And to add to the story, we find ourselves 4 months later again, and I don't know.
I think actually 2 months, huh?
2 months.
2 months. Right.
Yeah, BukaPO is going through the roof. We had pretty, let's say, stable growth projections planned, and then I speak with Olaf, and I was like, Tom, we just hit our double month revenue in 1 day from last month. Things are going wild here. So, yeah, it's been absolutely the traction in the last, I think, 2 months has been really amazing. And of course, when there's a lot more traction, it changes everything. We had a plan to raise more money for Olaf in a couple of months from now, also at a lower ticket. And with the traction, we're actually looking at opening a new ticket this month to help Olaf get to grow BukaPO beyond Bali. For us, there's every company, when it starts to move, it builds this momentum. And from our experience, it's really important to nurture the company at that point. And if the market is picking up the company, you have to push the company along into the market. Waiting will actually be potentially, might go actually against you, because then you give time for them to try copy you in the markets that you haven't opened up yet. So right now our plan is pretty much to look at 2022 and say, okay, BukaPO is validated in Bali. There's a demand for it. There's a growing market for it. The market hasn't even been and say, okay, what would BukaPO do when we open it to the big markets? And so we've got a lot of, let's say, investor excitement around that, foreign money as well. And this is, let's say, the other side of the funding dilemma, which is when you think you're going to grow slowly and like at a reasonable pace, and all of a sudden the company gets distraction and we have to change the plans. We can't just be like, no, Olaf, we're only giving you money again next year, June. It would be, you know, a huge mistake for everybody. So now we're picking up the phone and we're saying, listen, guys, BukaPO has just gone like ×6 or ×8 on their monthly revenues. We need to act on that. So adapting from that point of view is also really funny. How, let's say at the beginning, investment companies will, you know, stay a bit on the back foot and say, listen, we don't want to invest in you just yet. We want to wait, let you swim by yourself, but we'll give you some advice along the way. And then when the momentum comes, then it's almost then our job to, you know, to honor the growth of the company and say like, okay, BukaPO is moving by itself at this speed now. We have to support the company. We have to rethink how much money goes in the next round. We think the valuation, it's been like an amazing, like last couple of weeks, just because of all of this movement. And it's also, and that's where the relationship, you know, really comes into play, because we have to be aligned. So for the last like 2 or 3, like last 2 weeks, I think we've sat down a couple of times, yesterday again, on Monday again, to talk about, okay, what's happening in 2022, exactly how much money do we need, and what exactly are we going to do? Essentially, the money that we're preparing, what Olaf needs to do, the capabilities building that need to happen, they're all connected. And so for us, having that relationship where we can openly speak to each other and say like, okay, cool, Olaf, what is, you know, your global vision for the company? We'll explain how we see the company growing based on, you know, our experience and our investors' point of view. And then we align on that. And then we say like, okay, cool. We open a ticket for this amount. And as soon as the money's in, we activate the money against, let's say, this breakdown. And this is a lot of the experience that I've gotten this year from speaking with startups. Is many startups will come to you and say, oh, I need $100,000, I need $500,000, like some amount like this. And then you say like, okay, cool, that's great, but what are you going to spend it on? And then they can't give you an answer right away. Like you watch them thinking, it's like, oh shit, wait, marketing, or like they just start throwing terms out. And it's like, guys, if you don't know what you need dollars for, how do you expect us to give you dollars? Because we're not giving you money to just hold. Like when you're raising a round, you basically have to you should start spending the cash the moment you receive it, because that you're putting that money to work. Otherwise it sits in a bank account and it's actually not working. So this is something that happens a lot, is people don't know why they need the cash. They don't know how much they actually need. And then the valuation thing is quite interesting. And this is kind of, I guess, valuation is always, let's say, a tricky discussion, because there's this like global halo effect of everyone's looking out for unicorns and saying like, oh yeah, but in this market, this company was funded and they're making the same revenues as us and they're valued at $50 million. And it's like, there's a lot of, let's say, like artificial valuation inflation around the world. And for us, we always have to keep our serious hats on and be like, listen, guys, let's not look at what the rest of the world is doing. Like Europe, the States, they have different investing agendas and they invest in different ways. And so you can't really benchmark your company against another continent because it's just a different context. If we look at, let's say, the base rules of investing, especially at early stage, we would want to take normally a multiple of current revenues. That's the safest and most, let's say, fair way to value a company. Otherwise, we look at discounted future cash flows. The thing is, every single pitch deck we'll ever look at, it looks like this. It may be hockey stick. It's like, oh yeah, no, money's going down for 1 year, but then we're going 100x. It's the same pitch deck we get from everybody all the time. And we say, guys, yes, that's the dream. Everybody's living that dream, and that's why we start businesses. But be real, be realistic, and show us that you can build a company that grows steadily, and then maybe it can hockey stick. So an exercise we give to a lot of companies to help them think like this is we offer them a line of credit on a royalty finance, which is basically a loan that instead of paying fixed returns, so X amount every month, it's a percentage of your revenues. So let's say we'll take 3% of your revenues, so that at the beginning, when they're not making revenues, we're taking a small repayment, but then as they're growing, we're taking a higher repayment. So it always aligns to how well the company is doing. And then in the contract, we say, but if your projections are higher than your actual revenues, we still want you to repay against your projections. So it won't be 3%. If they're underperforming, it could be 6%. And you should see everybody turn white the moment you say that, because now they realize that we're going to hold them to their projections. It's like, guys, if you want to go 50x in the next 3 years, cool. We think it's unreasonable. If you're confident about it, let's hold you to your word and create a financing line of funding against that. Every time we've offered this, the startup comes back to us within 3 days with completely different financials, everything cut in half and stuff. And we're like, whoa, guys, like, what happened? Like, what happened? Like, you were so confident on Friday, like, you're going to take over the world, and now, like, you're settling for little village markets. What's going on?
Lucky I didn't do it, huh?
Olaf played it smart, and he downplayed his growth.
No, I'm not downplaying my growth. I'm being reasonable with the conditions.
Yeah. So that's pretty much also then the dilemma is like looking at what the companies are projecting, and projections, it's just putting a thumb up in the air. Nobody truly knows. What you can look at is what you've done in the last few months and be reasonable, as Olaf was saying. And he put on like a 3 to 5% growth or something like that, which is just slow and steady wins the race. And we said, you know what, let's run slow and steady for 3 years, see where that gets us. And slow and steady already looked like a decent case. And even though it didn't create a huge valuation for the company, we felt that we could trust Olaf and say, okay, Olaf, understand that good things take time to build, and it's about getting there rather than racing as hard as you can. And then by kind of setting that intention out, we got BukaPO at like a fair valuation. And now 3 months later, all the numbers are off the charts. He sent us some charts the other day, and you have this line of growth, like this little line of growth like that. And then the actuals from the last 2 months are way beyond. And now it changes the whole valuation of the company. And this is amazing because now in the 3 months, we'll have done quite a significant jump in valuation. And it's not even an estimation. It's based on the actual performance of the company, which is the most trusted, let's say, way to gauge a valuation and to look at then equity financing and things like that. So yeah, when you're talking about the funding dilemma, it's really a case of building relationships and understanding that it'll take time for the journey to be on this journey and for things to happen. And for us, from the investor's point of view, timing is very important, because timing essentially equals risk. And generally, if you're going in too early and you're not fully clear who's leading the company, how they're going to manage the next steps, it's very dangerous, because you could lose your investors' capital. But then once things pick up, you have to speed up with the company. So it's really building, and the relationship is what holds all of that together, communicating frequently, and just keeping each other up to date on what's going on. So when we get any news on what's happening in the market or potential opportunities for Olaf, then we share that with him, and then he tells us what he's deal with, and we look for solutions together, and then we map out the future together. For me, a startup and an investment vehicle should be partners in business. It's not just a transaction thing, like, cool, I give you a loan, you give me a positive ROI, and everybody has their own life. It's really like some sort of marriage where we have to be aligned on the vision of the company and which roles we have to play in that growth, and adapting when something new happens, which is either when the market reacts positively or something bad happens in the market, being there for the startup. And so my message, let's say to the companies that we'll be looking at next week, is if we say no, it's the best thing that we could tell you, because it means that we believe that you can actually push your company without capital. And a lot of things that people forget with the whole capital is, once you accept external money, you have a responsibility towards a third party. And it's not just you managing your business as you want. There's expectations behind how you're going to run your business. And different, let's say, investors or different funds have different expectations. Some will want to take a more active role in telling your company where to go next. Others might stay super passive, and other ones will want to collaborate with you and solve your problems together. So understand which fund you're actually speaking to and how they approach business. And if they say no, it's not because they don't want to say yes. It's just a no for now. And this is what I'll do to a lot of the startups that we decline, is I actually send them an email about this long, telling them why we won't fund them right now. And we say it's because of these reasons, from based on what's happening in your company. If you can work on those things, let's speak again in 3 months, because it will have shown to us that you're open to feedback. And the points that we recommend are always the most important metrics to look at the health of your business. And those are the metrics that any investor is going to look at and judge you on. So we don't mind if a company gets funded by someone else or something like that. For us, it's really being able to give our most honest and fair opinion, and say and there's some companies where we say, yeah, listen, we love what you're doing. We want to back you. It's already a yes, but you need to push by yourself for another 3 months. Push by yourself for another 3 months. It won't take the money you think it does. You can really play it as it is. Don't try spend more money. Just make the most of your cash, and then we will push you, and be ready for that push. And this is also something that I've had. Everyone's on the race to IPO, on the race to Series A. When a company reaches Series A, they've pretty much raised like a couple $1 million, like up to maybe $30-40 million. And I mean, that's an amazing achievement to do. But now you have the responsibility to spend that $40 million wisely, because the investors obviously want to back you for Series B, maybe for 80 million or 100 million, but they want to see how you spend that 35. And if you don't spend that 35 wisely, then they're going to be reluctant to investing in you again. They'll be looking at exiting early. So whenever you get any sort of capital from any investor, think of it as a test and saying, listen, we're going to trust you with $100,000. And if you do well with it, we will trust you with $800,000. And then we will trust you with 5 million. So be mindful that it's a journey. It's really a journey, and it's the quality of the relationship that makes it happen. And if the timing is off for the investors, it's really not the end of the world. It just means that you don't need investors right now, and you still have your freedom. The moment an investor takes 20%, 30% of your business, that's leverage, and that's essentially freedom that you don't have anymore, because there's somebody else on the board with other expectations, and now you're not steering your ship alone. There's people that are holding the wheel with you, and you've got to really collaborate. So it's very important to be aligned when you do that exchange of equity and bring external money, because otherwise you're gonna get bad surprises when you wake up, and it won't even be because someone is being nasty. It's just because you didn't fully understand what it means to get funded. So this is what I would invite startups to do, is really, why do they need the money, and do they really need it now? And if they really need it now, do they have a plan? Do they have a real plan? And do they know what other help they need? Cash is only one of the ways to solve problems, but advice, access network and things like that are a crucial part of your relationship with an investment vehicle. So yeah, I think I've spoken for I don't know how many minutes, but
yeah, it's okay. And wow, a lot of insight, because I don't want to stop you even though your time is up, Tom,
no,
but
no, this is
because
good. This is good.
no, because a lot of things that we is it's valuable for us, and also it's a good I mean, like, I don't know, in terms of Indonesia ada istilahnya kayak daging semua gitu isinya yang diomongin, Tom. Jadi all of the things that you share is very it's very useful for our friends who will pitch tomorrow, and also who will listen for us today. And wow, a lot of insight. I also take notes a few terms that you you share just now, but now that's from the point of view of the investors, right? But how about you, Olaf? What is your funding dilemma for you? Because I believe I don't know. I mean, like, normally, like startups do um, pitch to several investors, and then after
that's true.
that they get
Of
funding, and
course.
I believe you have that you already experienced that too. Then can you share us?
Yeah, I think like raising a funding is like chicken and egg, you know. It's like uh, the investment company or the VC usually wants you to have a sizable traction, right? On the other hand, we as a startup need funding to have that substance, that significant growth. And
Yeah,
then
yeah.
so it's like a chicken and egg.
Yeah,
if you
yeah.
if you go to a non-tech startup investor, like conventional investor, and when
Mhm.
you say like, okay, 10% for 200,000 or whatever the number is, they will laugh at you. I experienced that once. They will laugh at me,
Okay.
and then they close the Zoom. We have a 1 hours meeting, I think, with this person, the CEO and the CFO. So it's a good meeting.
Uh-huh.
And then when I said the numbers, 10% for certain numbers, they were like, "You're kidding me. Your revenue is only like, at that time it's like very very small, right?" So yeah, that's also I think a dilemma. Uh, but I think for me, I think what most startup focus on, maybe because I'm in e-commerce, most of them focus on GMV, right? On the
Mhm.
revenue.
Mhm.
Uh, but if you don't have fund to burn, then don't focus on that. Focus on the other key metrics that you don't need money to growth. Because if we, for us, we focus on low customer acquisition costs, and we are very focused on retention rate. Until today, if something happened, me as a founder still call the customer. If it's a big problem, I will say sorry to the customer. So what we do, it's not focused before you get the funding. Don't focus on what you don't have. Focus on what you have. Getting retention is not difficult. If you have 2 3 stuff, you can easily do it, right? Making phone call conventionally with WhatsApp or whatever. So I think we get a good valuation from Tom when we on the pre-seed funding. Uh, Next round, I think they evaluate us about $4 million valuation. But I'm quite sure. I don't know, Tom, but I think at the beginning, BIC is not give me valuation based on my GMV. I think they give me valuation based on the customer acquisition cost, the low customer acquisition cost, the customer lifetime value, and the retention rate.
Yeah,
And
yeah. So we discounted, we discounted the future cash flows, which is like your net revenues,
yeah,
looking at what you have at the end. and the most important one was saying like, okay, cool. As I said, projections are, you know, always thumb in the air.
Yeah.
But the customer lifetime value, the retention rates, those metrics are all real, and they're all powerful indicators to tell us whether people actually love BukaPO. And just to tell you, like, if you have a 50% retention in any business, it's very, very impressive. Like, companies with 30 to 40 are already very happy. Anything above 50 is spectacular. And for us, that was the signal that the people that were using BukaPO actually liked it because they kept on coming back. And this means that he doesn't need to have a bigger market for us to trust the concept. The people that he has are people that like him, and that's what we want to see when we're looking at potential.
Yeah. Hello.
Yeah.
Yeah. So basically, yeah. So basically, I think if you haven't get funded, just focus on what you have. You know, don't expect for like miracle of course, you know, we have all like a hope of getting funded, right? But focus on what you have. I think retention is very I rather have a 10,000 customer that shop with me 2-3 times a week than 100,000 customer that only shop to me like maybe once a month. So we really focus until up to now. We don't have a good customer base. We don't have a large customer base, but our growth is because of a high retention rate. So
Okay.
and as a founder, I think to have a high retention rate is not difficult. As a founder and CEO, it doesn't mean you're a boss in startup. You also sometimes you clean the table also, right?
Chief
So,
chief
chief
of everything officer.
So until up to this point, right? If we have a problem with merchant or with customer, I always call them privately. You know, I'm Olaf, I'm the CEO. I'm sorry for what happened. And then I will send you. By the way, I will send you some, you know, food tomorrow or whatever. So I think I think we I think we grow like 10x within 2 months from the last GMV. I think because we are empowering community first. Use and it's not we don't spend a lot of money on digital marketing. Even I think we only spend in digital marketing with this 10x growth, I think it's like 5 to 7 million a month, 10 million a month, something like that. So what we are aftering is really retention, because you know it's easier to have 10,000 loyal customer than to manage 1 million that you know only shop at you once. No.
So it means that quality is over quantity, right?
Yes, for me is yes,
Yeah.
because our ticket size, I think it's 250% above our competitors, because we're really focusing on that, you know, like quality, calling them, you know, if something happen, you know, do whatever it takes to solve the problem. If it's customer, and we treat the merchant and customer as the same level. So if the merchant get upset, I will call them, you know, because they have a fight with customers sometimes, you know. We have about 500, almost 500 merchant now. So I think, as Tom said before, its connection is very important. I think what we're building now, it's a connection. We have 3 times a week merchant training offline. We have once a month Zoom. So we're helping them with if they need a photo shoot, if they need a logo design.
Hi,
Hello.
Olaf.
Yeah, can you hear me? Hello. Hello.
Hello.
Hello. Yeah, I can hear you. Can you hear me? Can you hear me? Hello. Halo. Halo.
Ya, halo, kedengaran, Pak?
Ya, kedengaran. Oke. Kedengaran ya?
Yeah, kedengaran.
So yeah, so basically we making connection again, right? You make a connection with I make a connection with BIC as a investors, but you also making connection with our customer, with our merchant, and that's very important. I think that's also in the long run will help you. I think now customer loyalty is like in e-commerce, it's very how should I say this? It's everything is about price, right? Now you can move from you don't have a loyalty anymore in e-commerce. Whoever give the biggest discount, that's your choice, right? And can you hear me, Ade? Ade? Hello? Hello?
We can hear you, but I think Ade lost the connection.
Can you hear me now? Okay.
Yes, we hear you.
Okay. So yeah. So basically, what we're doing is really building a connection with the customer and with the merchant. Now, the dilemma is not also just how do you call that? Before you get funding, getting a funding is one thing. It's one dilemma. But once you get to the point where you get the funding, you have more dilemma than you can think. People always think once you get the money, oh, okay, now my life will be much easier. No, your life will not. You never think your life will be easier once you get the funding. It's like 20 times more pressure than when you growth organically.
Agree.
So yeah, in funding, when you looking for funding, you doing it like pitching, like every day and maybe like 3 times a week or whatever, right? But once you get the funding, your dilemma become like every hours. You have a problem to solve every hours.
Hi, Olaf. So sorry.
Yeah, no
Suddenly
worries.
my internet connection is down. I
Yeah,
don't know
no
why.
worries. I just
So, so,
continues.
so.
I'm just continue talking. I don't know whether they can hear me.
Yeah. It's okay. It's okay. Yeah. Yeah. I think it's a very a lot of great insight. But what you said just now, like before I got lost connection, I think that what you tell us is actually like what we feel and what we experience. Like for example, like focus on what you have instead of what you don't have, and I think it's not only for valid for life but also for startup life, like, right?
Yeah. No, it's very important.
Okay, because like a lot of quotes say that focus on what you have, not what you don't have, but I think it's also valid for the startup life and startup journey, right? And also you say that it's important to focus on the if you don't have money to burn, then you don't focus on GMV, but instead you focus on the retention rate with low cost
Yes,
of
sir.
with low acquisition costs, right? And I think several questions that I want to ask. You guys, if you have any questions in the Zoom, just feel free to drop questions in the chat box, or maybe you want to ask directly to Tom and Olaf, and then you can raise hand and we will go to you. Meanwhile, I have a questions for you, Tom. First, how do you define a potential traction? I mean, like, what kind of if you say that if you uh, check you get the pitch deck, and then the chart is, for example, it goes here, and then after get funding is went up like crazy. But how do you define a potential traction from the investor point of view, until you can say like, okay, voila, this is the we will go with this startups.
So for us, it's really a case of looking, as exactly as Olaf said, is what the company already has. All the financial models, they all actually look the same. Some just have different margins because it's different sectors, but they all look the same. So it's like, okay, guys, yes, we know that slide is coming. It looks beautiful. Show us what you really got. What do you have as of today? What have you done? Tell us about your story with your customers right now. And this is for us the proof, and this is the only way to really see whether the company's actually telling the truth, in the sense of like, okay, this is where we want to go. So projections are obviously future looking, but now let's look at the past. Let's look at the present. Where are you right now? And are you already on that trajectory and money just helps you get you faster? Or are you waiting for money to get that traction? And as Olaf was saying, the chicken or the egg, it's kind of like this. It's like, yes, but if you give me more money, I can do more marketing. I can get more customers. Yes, of course. We've done this. I've done this in Germany. We had like millions of euros to spend, and then we burned through the whole German markets in 3 weeks because we had so much money, but the app was broken. So there was 95% churn. So 95 out of 100 people didn't even get to the welcome screen because the app was broken. So money doesn't solve your problems. And if we see that you're waiting for money to solve your problems, for us, that's a red flag. We want to see that you are actually taking care of your customers. And as Olaf was saying, it's in a lot of the, let's say, businesses, it will be like recurring sales or monthly or weekly active users or even daily active users. And we'll have people that launched apps that come to us and say, oh yeah, no, but look, we got 100,000 downloads, like, we're huge. And then we say like, okay, cool. So then what's your weekly actives? And then they say like, oh no, 100 people. And it's like, okay, so 100,000 people downloaded your app and now only 100 of them are actually using it. So you don't have 100,000 customers, you have 100 customers. And so it's pretty much understanding which metrics are the truth metrics. And the truth metrics are your churn rate, your active users, so monthly, weekly, or daily, depending on the type of business, the customer lifetime value in relation to the customer acquisition cost, which is how much does it cost you to get one customer and how much money do you think you're going to get from that customer. And just looking at these metrics, we know what's happening with the company, and we already know where there's potential red flags and where money will help or where thinking will actually help. 50% more, 70% of the problems that we face and we talk about, money doesn't solve it. It's better customer service. And as I was saying, better customer service takes 1 to 2 people. And it's replying to emails when people send you an email, calling people to check up on them, just being human and actually caring. And the moment that customers feel that you actually care about them, they will love you more and they will tell their friends to shop by you also. And there's nothing more powerful than word of mouth to grow your business. So if you have 5 or 10 customers, make them feel like kings and queens, make them feel really special, and they will give you the statistics that we look at. And then we say like, okay, cool, you know how to look after 100 people or 1,000 people very, very well. Now we're going to help you do the same, but for 10,000 people or for 100,000 people. But if you can't show us that you don't know how to look after a small group of people, how can we trust you to look after more people? It's as simple as that. We have to see that you can handle small and that you know what's important in nurturing your customers, and then we go forward.
Okay. We have questions from David Rama. David Rama.
Yeah, hi guys. Hi Olaf. How you doing, buddy? Hey, congrats on your fundraising. Hey,
Thank
Tom.
you.
Taking good care of this guy, hopefully. So I know this guy from way back. I have questions for both of you. I mean, you guys touch a lot of the key metrics and whatnot. So actually, all the key metrics is just a proven, one of the tools that proven trajectory ahead, whether your founders understand how to grow the business and whatnot, right? But I think we should also touch base on the broken cap table, because especially for early days, right? And I mean, some of the investors don't really understand about trying to gain equity. A lot of equity will be backfired to them in the future, right? So they will. Well, okay. Questions for Olaf first. Do you have any preempt initiative from being deteriorate your cap table? And then same question to you, Tom. Thank you.
Okay, who wants to go first?
What was the question? Being what?
I'm losing you guys.
What was the question again? Being
all right, the question is, you know, I think that the most the most that we haven't discussed, you guys haven't discussed on this dilemma of fundraising is the broken cap table, right? And then, so what would be your preempt initiative from being deteriorated by messy cap table in the future? The question for the founders, Olaf, and then from the investor side.
Tom, you want to go first?
No, you go first, Olaf. Tom, let him go first. Let him go first. Let him go first. I just want to put him on the spot.
Well, for me, it's I don't know. For me, it's because when I built this company, I really never think, you know, we're gonna get like funded and then we're gonna go 10x and then, you know. So for me, for me, the most important thing, my vision is how do you call that? I can execute my vision. So in terms of shares, in terms of course, you know, you don't want to lose too much share, but for me, it's better to have a valuation than no valuation at all. So that's my answer for your question.
Yeah, we can go offline after that. But anyways, now I'm just trying to put him on spot. I don't like his answers, but anyway, it's my bad. So Tom, yeah,
maybe you can finish over coffee or something.
Over margaritas.
Over margaritas. Okay, that even better. Okay, what about you, Tom?
Yeah, for us, it's also it's a really nice question to ask, because that's also like a dilemma in its own, where lots of startups are looking for what most of them see as free money. Free money is equity money, because it's like, oh, we give you some equity, we don't have to pay it back. It's, you know, the whole deal of holding equity is that there'll be an exit or it's going to grow in value at some point. So that's not a debt. But an early stage equity is it's a potentially very dangerous road to go down, because that's when your company is valued the least. And so when you're asking for, if you're, you know, $100,000, $200,000, you could have an investor take almost like majority share in your business straight away. And when we look at, you know, doing financing deals, we always explicitly kind of mention this to especially the younger entrepreneurs, and we say, listen, we're offering you a debt deal not because we want you to pay back, but because it's protecting your equity until the next round. By giving you a debt right now, yes, you got to pay us back the money, like you owe us money, but you still hold your equity. And then when you get to the next round, we'll do an equity round for you then, but your company will be valued 4 or 5 times more, which means that for the same money, you only give away 4 times less of your business. This is one of the deal sheets we have now, where the founder wanted us to give him an equity deal. And we say, listen, if we value you right now, we take 100% of your business, because that's how early you are. Like, if you want to do that, sure, then you literally just work for us, but it's no longer your business. So we couldn't offer that. So we said, listen, we'll do a 2-step approach, similar to what we did with Olaf. But the first one is more of a convertible like note or a royalty loan that can be converted. And we say, listen, we set you up with a loan, you hold your equity, and in 9 to 12 months time, once you've grown your company some more, then you'll have a real valuation, and we can either look at converting then or refunding you on equity then. And that way you protect yourself. And so for us, obviously, as investors, we have to be careful. Well, our job is obviously to secure, positive or strong returns for our investors, but we can't do it at the cost of the startups. So this is where the entrepreneur has to understand the cost of capital, the cost of money, and say like, okay, cool. What's it actually going to cost me in the short and long term if I go equity now? What's the short and long term cost if I go debt? Should I be mixing the two? Should I be using one at this stage and then one at a later stage? So this is something that we always educate the early startups on, and something that, as you said, every entrepreneur needs to be mindful of, because some ventures won't give you that speech. They'll just say yes to what you offer, even if it's not to their best interest or to the entrepreneur's best interest.
Understood. So having said that, what would be the bracket ideal size for founder to attain their share in, let's say, seed stage?
What would be the ideal?
The ideal share, number of equity of founders when they raise funding in the seed stage. Let's say just start with the seed round.
So with
Your
the seed
opinion, Tom.
round, if it's like, let's say there's multiple co-founders, we want, let's say, the co-founders to hold around like 30% each. And I'll show you the backwards calculation for that. Is basically
sure. You don't have to. Sorry, I'm sort of know the everything the formula. So, but 30% of each. Say if they have a multiple, let's just use two founders, right? So they have attained 60% at the minimum each. So it means the whole total funders will let go 40% of equity, and approximately when they raise seed round, they will let go another 20 to 25% equity, right? Would we agree? I mean, sort of like the ideal milestones of how you're going to fundraise and how many equity that you want to let go, right?
Exactly.
So let's say you understand at I mean, one of the investors, which is you represent the investor BIC, that understands all the milestones of the ideal shareholders and whatnot. But again, you said earlier, and I agree with you, investing of founders is just like a married life, right? But then this is a unique marriage because it will be polygamy, right? It's not only married to one founder, right? So meaning like in some extent, you will help the founder to explain to other investors, right? I mean, like if they become very greedy and then there will be broken cap table in the futures, then everybody lost, right? I mean, like it will be hard to raise another funding in the next round if you have a messy broken cap table. So
exactly.
Okay, I'm sort of lost of my questions. Okay, so what will be, probably this is a BIC in particular as investors of BukaPO. Will you be actively help this guy to explain to other investors or to negotiate or fix the broken cap table? Because I'm not gonna mention it here, but I know how many equity that he's holding now, right? And then I'm not saying it's a broken cap table now, but I think it will be start deteriorating if nobody help him to keep the shareholders.
No, so I think we still have a very good because we have 3 co-founders, so I think we still have a very good how do you call that, a cap table at this time
for pre-seed.
Yeah.
Seriously?
Yeah. We still have we still have, because we have 3 co-founders.
I know, and Tom just said that pre-seed should be 30% each. I mean, and I agree.
We have about 60%, all the co-founders.
Yeah,
in
for
total,
pre-seed.
yeah, of course.
Yeah, Anyways,
Yeah,
that's
in total, much
actually
more than this. We earn like we own a minority in BukaPO right now.
Yeah,
But to answer, let's say on that is pretty much so we're looking at opening the next round for BukaPO literally in the next few days.
right.
And so we took the, let's say the amount of money that we feel is the right amount of money BukaPO needs right now. And
Right.
then we break that down in terms of what does that translate to into equity. If we ask for X amount of money, how much equity do we ask for? What's the valuation of the company then? Because let's say a rule that we apply is that a company should have issued no more, let's say, than in most cases is 40% of its shares by the time it reaches Series A. So the next round that we'd be looking at doing with Olaf is probably
Okay.
it's like it's a pre-Series
So
A.
your voice broken up.
Yeah.
Tom,
So can you
Tom,
hear
your
me
voice
now?
is broken up. Sorry. Yeah. Could you repeat the last couple
Yeah.
seconds?
So we believe that the company that an investment vehicle, so a third-party investor, should hold no more than 40% in the startups by the time it reaches Series A, because then we're bringing in other investors and there's dilution. So when we looked at this new round, we said, okay, we want to significantly increase the ticket size for BukaPO because it needs to accelerate, but we have to revisit the valuation so that we take a fair piece of equity for it and we don't become majority shareholders. So this is what we're discussing and saying, okay, from a equity issue point of view, the valuation needs to be X. Does the performance of the company meet that? Can we marry the performance with the valuation? We need to take only what's needed in terms of equity to make it a fair deal. And what's the difference between the two? Are they already aligned? Do we need to apply some goodwill? So for us, we start obviously that as the lead investors. So Bali Investment Club is the lead investment for BukaPO, which means that we're their funding partner. And ideally, at least until the Series A stage, we're the only source of capital, the direct source of capital for BukaPO. So we invite other investors to invest through us as we're in partnership with BukaPO and we helping them make their business go forward. So we try to stay as mindful as we can in the early rounds to reward, let's say, our anchor investors, the people that took the first risk in the last round, rewarding those, providing a fair valuation growth for Olaf in this coming round. And then afterwards, it's a matter of scaling, of being able to scale the company hard. And this is when you can, let's say, maintain a positive cap table from the investors, from the founder side, because if the company, let's say, would have gone 7x in this round, it means that the cost of capital is significantly lower from equity because it's gone 7x. And in the next round, if we can achieve, let's say, another 7x or 10x, then the equity issue is significantly lower. And then there's also then a dilution effect across all existing shareholders. So the idea is really that when you're going to get more money, another round through equity, you want your business to have done a big jump. Otherwise, as you'd say, you eat the cap table within 3 rounds and the founders left with 20%. All the co-founders can be left with 20%. So if you're raising more money, you've got to have made a big jump in valuation. Otherwise, rather just take on debt, take on a loan, and use that cash to get you to that higher valuation.
All right, understood. Thanks for answering. Another question, Tom. You just investing in Bali or other regions?
All over Indonesia. So we're Bali Investment Club because we're based here, and this is where BIC was born. And we're looking at fostering, obviously, Balinese startups. But we speak with the whole archipelago. And right now, we actually have offers out for some startups in Jakarta, Surabaya. And then we're looking also East Indonesia in the agri space going forward. So based out of Bali, but serving the whole of Indonesia.
Yeah, and also
our
Sumatra.
goal is yes, and
Sumatra.
also Sumatra.
Palembang to be exact, yeah.
You mentioned Sumatra.
Yeah.
I'm in Sumatra.
Yes, exactly. So for us, it's about supporting Indonesian entrepreneurs and really only backing companies that have a strong impact and environmental and or social impact. So for us, it's is good for the planet or good for the people part of the business journey, and is it also serving the groups in the most needs, and this is what we base our investment thesis on.
Okay, is this a sector agnostic or any particular?
Yeah, so let's say sector agnostic in the sense that for us, impact is about enabling startups across different sectors, and that's for us how you elevate a country or an economy. And then in terms of specializing, I think we look at pretty much companies that serve the bottom of the pyramid groups. So let's say the biggest population also segment in Indonesia, but the ones with the most need. And then we look at things like waste management and new ways of farming and things like that. So sustainability is a big part of the projects we look at, and waste management, supply chain is a huge topic. And we're actually working on backing a couple of companies that are part of the same supply chain. So they're each other's customers and suppliers, to strengthen those businesses and to also get rid of more flippant trash. This, I think, is always a big shocker when people come to Indonesia, is because the islands are small. You see the trash,
Right.
and it's not even time to do something about it anymore. It's an obligation, at least for our generation, to tackle those projects, and most of them can actually be very good businesses. So we're looking at backing those sectors mostly, and then keeping our minds open on things like edtech, which takes a little bit more time for us to find where to place our focus.
Thank you.
Okay.
That's it from me.
Okay, I think, thank you, David. By the way, David Rama, where are you from?
Based in Jakarta, so being back and forth to Bali.
Oh, I see. Okay. Thank you for your questions, David.
Thank you.
And
Thank you all.
yeah, I think we are at the end of our events for today. But before that, can you give me 3 words to our friends who are watching us today, the startup enthusiasts and its startup will to pitch? And I think 3 words is enough. Maybe from Olaf first, from startup
Three
point of
words.
view. 3 words for
Okay.
our startup friends out there.
Okay. Solve the problem, execute.
Solve the problem, execute. Okay. And then that's 2 words. Solve the problem, execute.
And
2 words,
execute.
1 word now.
Okay. And review.
Review. Okay. What about you, Tom? 3 words
Yeah.
for startups.
3
was
words
gonna-
or 3 sentences? Are you talking about words or sentence?
3 sentences, sorry.
Okay, now you
Do you want to carry on, Olaf?
No, I'm okay.
Okay. Yeah, I would say the first one is always the famous one, is just do it.
Just do it. Okay.
Just do it. Like,
Just do it.
ask yourselves less questions. Just do it and learn as you're doing. And the other one is follow your heart. And if you trust yourself, if you follow your passion, then you'll end up doing something good. And be true to yourself. That's the most important part. Is don't try to be somebody that you're not. Be who you are. Follow your heart. Just do it, and that's how you'll end up building a business that you enjoy working in, and that people will enjoy interacting with.
All right. Thank you guys for your time. Okay. For everybody who are listening us this morning, where we just spent our 1 hour of very great sessions and very interactive sessions. discussions, and also a lot of insight that you get from these sessions in the side of funding dilemma. We all already hear what is the funding dilemma in the point of view of investors, and also we already hear what is the funding dilemma in the startup point of view. And I hope from that, then you can give you a better understanding and make your pitching sessions in the next I don't know, next time, if you can pitch better. And a lot of insight that we have is from Olaf. Chicken and egg is very true, and chicken and egg is very true. And focus on what you have, and then focus instead of focus on what you don't have. And then from Tom's, no doubt that's a lot of insight from him. And remember what Tom said, that actually the investing is a journey, and building a relationship takes time. Timing is very important with the equal risk. And when startup and investor should be partners in business, it's not just a transactions. That okay, guys, thank you so much. Have a nice
Thank
weekend. Maybe
you.
if I can
Yes,
Thank you,
you
come,
too.
Ade.
yeah,
Have a nice
if
Thank
I
you
weekend,
for
come
hosting
guys.
to
us today.
Bali, I will meet you both
Of
in
course.
Yes,
person.
yes, we catch
You
up next
Okay.
must.
week.
Bye
Take
All
bye.
right.
care.
Bye-bye.
Bye bye.
Okay, now we are going to continue. The next session is Founders Playdate, and I will invite my colleague Kun. Hi Kun, how are you?
Hi, how are you?
Yeah,
I'm good.
okay. I think I